What if there exists a secret corner of the financial world, a world of private, largely unregulated money, that consistently finds ways to generate staggering wealth, irrespective of whether the overall market goes up or down? You hear the names: Soros, Simons, Dalio. They represent an elite class of financial players, the hedge fund managers, who operate under a philosophy fundamentally different from the average investor. They are not content to simply track the market. Their singular goal is absolute return. They aim to profit from every crack, inefficiency, and irrationality they can find in the global financial system. This world, often viewed with a mix of awe and suspicion, holds the ultimate lessons in risk management, psychological discipline, and market mastery. The strategies and mindset that generate billions for the elite are, in fact, built on principles that any intelligent investor can and should apply to their own retirement account. Welcome to Capitura. Today, we're not just looking into a controversial industry. We're extracting the timeless wisdom of the masters of finance. We're going step by step through Sebastian Mallaby's definitive historical account and psychological deconstruction of this elite group. More money than God, hedge funds and the making of a new elite, the author and the unseen power. Sebastian Mallaby is a distinguished journalist, author, and senior fellow at the Council on Foreign Relations. His perspective is unique. Rather than offering a simple expose, he provides a deeply researched, comprehensive history of the hedge fund industry, gaining unprecedented access to its most secretive figures. His goal is not to justify the wealth of the managers, but to understand the systemic forces they represent. Mallaby argues that hedge funds are the financial world's ultimate Darwinian proving ground. Only the most intellectually agile, disciplined, and rigorous systems survive. The book reveals that the source of their success lies not in illegal insider trading, but in a relentless focus on three principles: flexibility, the ability to move capital across any asset class globally; leverage, the disciplined use of borrowed money to amplify returns; risk management, the systematic, ruthless prioritization of avoiding catastrophic loss. Why hedge fund wisdom matters today. The world of hedge funds may seem distant from the average investor using a low-cost ETF, but their principles are more relevant than ever for navigating today's hyper-volatile markets. The volatility crucible, Noah effect hedge funds thrive on the market's chaos. The wild, unpredictable swings in crypto and meme stocks are classic examples of the fat tail risk, Noah effect, that hedge funds are uniquely structured to profit from, either by shorting volatility or by exploiting sudden mispricing. Their focus on absolute return means they profit from both bubbles and crashes. FOMO versus skepticism. While the retail investor is driven by FOMO, fear of missing out, the great hedge fund manager is defined by skepticism. They look for flaws where others see genius. Their rigorous fundamental analysis, like that of Stale in The Art of Short Selling, is the ultimate filter against hype.fire movement and risk protection. For the fire investor, the hedge fund philosophy teaches the crucial lesson that preserving capital is more important than maximizing gains. Their systematic approach to identifying and hedging every risk is the ultimate guide to building a portfolio resilient enough to survive decades of market cycles. We're going to explore the history and strategies of this elite class, learning how their unique structure and psychological discipline allowed them to generate more money than God. Chapter 1. The Inventor. Mallaby begins a journey by introducing the spiritual and structural founder of the hedge fund concept, Alfred Winslow Jones. The story starts not in a modern skyscraper, but in the academic world of the post-World War II era. The genesis of the hedge fund. In 1949, Jones, a sociologist and financial journalist, articulated a revolutionary idea that would define the industry: the hedge. The original hedge, Jones realized that the market was composed of two risks: market risk, the risk that the entire market goes up or down, and stock-specific risk, the risk that an individual stock outperforms or underperforms. His innovation was to create a fund that would neutralize market risk. The structure: Jones combined long positions, betting a stock would rise, with short positions, betting a stock would fall, borrowing the stock and selling it. The goal was to profit from the manager's skill in stock picking alone. If the market rose, the long positions would profit and the short positions would lose money, roughly canceling each other out. The net return would come from the difference between the outperforming longs and the underperforming shorts. The fee structure. Jones also pioneered the revolutionary fee structure, charging a small management fee plus a large share of the profits, the famous 2 and 20, 2% management fee, and 20% of profits. This aligned the manager's interest directly with the client's interest in generating absolute returns. The core hedge fund philosophy was established: profit regardless of the market's direction, the psychology of absolute return. Jones's structure fostered a unique psychological profile among managers. Conventional fund managers, who track an index, only fear losing relative to the benchmark. Hedge fund managers, focus on absolute return, feared losing money entirely. This fear instilled a deep, almost existential focus on risk management. Modern investing application. The original hedge fund concept is the ultimate model for non-correlated returns. The retail hedger. The average investor can conceptually apply Jones's hedge. While they may not short individual stocks, they can use non-correlated assets. Holding a mix of global stocks and high-quality government bonds, or gold, is a form of hedging against systemic market risk, aiming for a smoother ride. The absolute return goal. The FIRE investor can adopt the absolute return mindset. Their goal shouldn't be to beat the S&P 500, but to achieve a safe, consistent return, e.g., 5 to 7%, with minimal risk of permanent loss. This absolute focus forces them to prioritize capital preservation above all else. Crypto arbitrage. The hedge fund concept of exploiting this pricing is everywhere. The differences in Bitcoin prices across various global exchanges are often exploited by automated hedge fund strategies, using the Jones concept of going long on a cheap exchange and short on the expensive one simultaneously. The key lesson of Chapter 1 is that the greatest returns are often achieved not by chasing high risk, but by systematically neutralizing unnecessary risk. Chapter 2, The Genius. This chapter introduces the second titan of the industry, who established a high-stakes, ruthless style of global macro trading: George Soros. Soros and reflexivity. Soros was the primary proponent of the global macro strategy, making highly leveraged, directional bets on entire economies, currencies, or interest rates. His genius was rooted in the philosophical concept of reflexivity. Reflexivity defined. Soros believed that markets don't just reflect economic reality, they influence it. Market perceptions and expectations can become self-fulfilling prophecies, creating a feedback loop between valuation and fundamentals. A rising stock price, a perception, attracts more buyers, allowing the company to raise capital cheaply, which improves its fundamentals reality, further driving up the price. Exploiting the flaw, Soros looked for moments when a reflexive feedback loop was dangerously out of sync with reality. His most famous trade, betting against the British pound in 1992, was a bet that the market's perception that the pound was overvalued would become a reality, forcing the government to devalue the currency. This single trade earned him over $1 billion. The psychology of the macro trader. Global macro trading demands a specific, rare psychological profile. Conviction and size. Macro bets are typically concentrated and highly leveraged. They require the manager to have a conviction to be massively right when everyone else is wrong, and the psychological fortitude to withstand enormous short-term losses, no effect. Flexibility. Soros was famous for his emotional agility. He had no ego about being wrong. When the market moved against his thesis, he would ruthlessly cut his losses and often reverse the trade. Modern investing application. The Soros philosophy is about identifying and betting on the Joseph effect, the long-term persistence of a trend, even a dangerous one. Betting against a meme, a Soros-inspired trade against a meme stock or an overvalued concept, will be a bet that the reflexive loop of hype and rising price has become unsustainable. The thesis is that the market's perception, high valuation, will soon force reality, massive loss of confidence, resulting in a collapse of the stock. The hedge fund is betting on the inevitable Noah effect, the retail reflexivity. The Robin Hood generation embodies retail reflexivity. A rising stock price creates a perception of genius among the buyers, which attracts more buyers, reinforcing the price. The risk, as Soros knows, is that the perception is not anchored to any underlying reality, making the eventual correction violent. The antidote. Cutting losses. Soros' relentless discipline in cutting losses is the ultimate lesson for the average investor. The moment a trade goes against your core fundamental thesis, you must exit. Ego has no place in investing. The key lesson of Chapter 2 is that the greatest fortunes are built not just on predicting the future, but on understanding how the market psychology creates its own reality. Chapter 3, the quant. This chapter introduces the modern era of hedge funds, led by James Simons of Renaissance Technologies, whose work pioneered the systematic quantitative strategy. The rise of the machine. Simons, a brilliant mathematician and codebreaker, realized that the market's chaos, the Joseph and Noah effects, could be tamed not by human intuition, but by mathematics and computers. The strategy medallion fund Simons built a fund that did not rely on economic forecasts or fundamental analysis. Instead, it used massive amounts of data and complex algorithms to find tiny short-term statistical anomalies and mispricings across the market. This is a form of statistical arbitrage, the edge. The fund's edge was the sheer speed and volume of its trades. It traded thousands of times a day, making small, high-probability profits on each trade. The risk of any single trade was almost zero, but the collective returns were staggering. The fund medallion is perhaps the most successful investment vehicle in history. The psychology of the quant. The systematic strategy requires a completely different psychological framework than either Jones's long/short hedge or Soros's macro bet. Absolute faith in the model. The quant manager must have absolute faith in the mathematical model, even when the market moves irrationally against it. There is no room for human intuition or emotion in the trade execution. The scientific method. The firm operates like a science lab. Every trade is an experiment, and failure is seen as a data point, not a personal mistake. The focus is on relentless testing and refinement of the model. Low correlation. The quant strategy is the purest form of Jones's original concept of non-correlation. Because the strategy relies on short-term market inefficiencies, it is largely divorced from the long-term direction of the stock market. Modern investing application. Simons's work is the ultimate validation of the system two mind over the emotional system one mind, as per Kahneman. The validation of the formula. The consistent market-beating success of Renaissance Technologies is a definitive proof that simple, bias-free formulas outperform human intuition, as demonstrated in Mallaby's critique of the illusion of validity. Passive investing's foundation. The success of quant strategies validates the core principle of passive investing. If sophisticated quants can only gain an edge by trading thousands of times a day with computers, the average human investor has virtually zero chance of gaining an edge through intuitive stock picking. The rational choice is to own the entire market and capture the base rate. AI-based investing. The explosion of AI-based investment tools is directly inspired by Simons. These tools aim to automate the search for statistical anomalies, eliminating the emotional flaws of human decision-making. The key lesson of Chapter 3 is that the deepest, most durable edge in the market is found not in brilliant ideas, but in systematic, unemotional rigor. Chapter 4, the Maverick. This chapter explores the unique culture and psychological requirements of a highly specialized hedge fund strategy. Distress investing, personified by managers like Michael Price. Distress investing and deep value. Distress investing focuses on buying the debt or equity of companies that are facing severe financial trouble, often on the brink of bankruptcy. The strategy. The distress investor uses deep fundamental analysis, like Staley short-selling analysis, but in reverse, to determine if the company's assets or underlying business model can survive the crisis. They are looking for assets selling for far below their liquidation or reorganization value. This is the ultimate form of value investing. The source of profit. The profit is generated by the complex legal and financial maneuvering that occurs during a restructuring or bankruptcy. The manager's skill lies in predicting the ultimate value of the post-reorganization entity. The psychology of the maverick. This strategy requires an extreme form of psychological isolation and tenacity. Contrarianism to the extreme. Distressed assets are the most hated and feared assets in the market. The manager must have conviction to buy when the Noah effect, the financial flood, has already hit and everyone else is panicking. This is the ultimate contrarian act, as stressed by Pring. Patience and legal rigor. The restructuring process can take years. The manager must have the patience to hold the asset through prolonged legal and market uncertainty, demanding a deep understanding of bankruptcy law and corporate finance. Modern investing application. The distress philosophy provides the ultimate lesson in buying low and ignoring the emotional noise. Buying the COVID crash. The 2020 COVID-19 crash was a temporary, systemic shock that created a distressed environment. Companies in the travel, leisure, and energy sectors were priced as if they would never recover. The average investor who had the psychological fortitude to buy airline or hotel stocks in March 2020, when the fear was at its peak, was engaging in a form of disciplined distress investing. The long-term value anchor. The distressed investor's focus on liquidation or breakup value is a crucial lesson in setting a true, objective value anchor. For the average investor, this translates to demanding a strong margin of safety. If you buy a stock for less than its cash on hand plus hard assets, your downside is largely protected, even if the business fails. The key lesson of Chapter 4 is that the greatest fortunes are found not in chasing the latest trend, but in possessing the psychological fortitude to buy what the collective herd is desperately trying to sell. Chapter 5, The Globalizers. This chapter focuses on the expansion of hedge fund strategies into global markets, examining managers who successfully manage capital across multiple countries and asset classes simultaneously, cross-market arbitrage, and risk. The globalizers use their flexibility, Mallaby's core principle, to execute strategies that required highly complex cross-market analysis. The arbitrage opportunity. They look for pricing inconsistencies between identical or related assets traded on different global exchanges, e.g., a stock trading in London and New York. They will buy the cheap asset and short the expensive one, locking in a near risk-free profit. The risk factor. The major risk in global arbitrage is sudden regulatory or political intervention. A government might suddenly halt trading or change currency conversion rules, turning a safe arbitrage into a catastrophic loss, a localized no effect. The psychology of complexity. Global trading demands intense analytical rigor to manage geopolitical risk and currency fluctuations. Understanding geopolitics. The manager must have a deep understanding of macroeconomics, political instability, and cultural norms. The financial decision is intertwined with the political prediction. The scientific method, global to systematic managers applied the Simons-like scientific method to global markets, using models to quantify and profit from cross-border statistical inefficiencies. Modern investing application. The globalizing philosophy teaches the average investor the value of diversification beyond domestic markets and the crucial need to understand currency risk. Global diversification. The base rate to fire investors' global ETF portfolio is an acceptance of this philosophy. By diversifying across developed and emerging markets, they are betting on the global Joseph effect, persistence of growth, and ensuring their portfolio is not solely exposed to the risk of a single domestic market's collapse. The currency trap. When investing in international stocks or bonds, the average investor often ignores currency risk. A foreign stock might rise 20%, but if the investor's domestic currency strengthens by 15% against a foreign currency, the net return is only 5%. The global manager's success emphasizes the need for the average investor to at least be aware of this risk when using international funds. The key lesson of Chapter 5 is that risk and opportunity are not confined to domestic borders. A truly intelligent portfolio is one that is globally resilient and profits from worldwide inefficiencies. Chapter 6, The Pioneers. This chapter explores the innovative strategies that push the boundaries of what was considered investing, particularly focusing on credit and derivative markets. Credit investing and derivatives. Managers began to move beyond simple stocks and bonds into highly complex assets. Distressed debt, again a deeper specialization in distressed assets, focusing on the highly fragmented market for bankrupt companies' debt. This requires specialized legal and financial expertise. Structured credit, investing in complex, securitized products like mortgage-backed securities and collateralized debt obligations. This strategy requires a deep quantitative understanding of the underlying assets and their correlation. Derivatives, the use of options, futures, and other derivatives to amplify returns, leverage, and precisely manage risk. Hedging, the psychology of the pioneer. Pioneering these strategies demands exceptional intellectual audacity. First mover advantage. The first managers into a new market, like complex credit derivatives, often reap massive rewards because the market is inefficient and the competition is low. The risk of the unknown. The innovator faces the risk of the unknown. The systemic risk of structured credit, which led to the 2008 crisis, was not fully understood, turning seemingly safe strategies into catastrophic failures. Modern investing application. The pioneer story is a warning about the alluring complexity of financial products. Complexity is risk. The average investor should adopt the principle. If you don't understand the underlying assets and their correlation, don't invest. The complexity of derivatives and structured products obscures the Noah effect risk. The 2008 crisis showed that when complexity fails, it fails systematically and violently. Leverage is a double-edged sword. The use of derivatives and leveraged ETFs allows retail investors to amplify gains' greed. The hedge fund success stories show that leverage only works when coupled with ruthless, systematic risk management. For the average investor, using high leverage without that systemic defense is pure speculation. The key lesson of Chapter 6 is that financial innovation often precedes massive crisis. Simplicity is the surest defense against the systemic, hidden risks of the financial frontier. Chapter 7, The Crash. This chapter focuses on the hedge fund industry's greatest existential crisis, the near collapse of long-term capital management, LTCM, in 1998. LTCM, the apex of hubris. LTCM was founded by Nobel laureates and PhDs, aiming to exploit mathematical arbitrage opportunities across global markets. The strategy. The fund made highly leveraged bets on tiny deviations between similar bond prices, assuming the deviations would eventually converge. They used a Gaussian bell curve model, assuming that extreme events were impossible. The failure. The Russian financial crisis in 1998 triggered a global flight to safety. The tiny deviations did not converge. They diverged violently, and the market became completely irrational. This was a massive, sudden Noah effect that the Gaussian models predicted was statistically impossible. The fund's massive leverage meant the small losses were amplified into a multi-billion-dollar failure. The psychological lesson. LTCM's collapse was a failure of intellectual hubris. Illusion of control. The founders, brilliant mathematicians, believed their model was perfect and immune to the market's irrationality. They confused statistical certainty with real-world security. The systemic risk. The size of the fund meant its failure threatened the entire global financial system. Modern investing application. The LTCM story is a permanent warning about the danger of over-reliance on flawed quantitative models and excessive leverage. Leverage kills. The most direct lesson for the retail investor is that leverage amplifies both returns and the inevitability of the Noah effect. The average investor who uses margin trading or leveraged ETFs must understand that they are playing a version of the LTCM game on a smaller scale. Even a small, unpredictable market move can lead to an instant amplified loss. The fractal truth. The LTCM failure validated Mandelbrot's work, Chapter 7. The bell curve, which LTCM used, failed because the market's fat tails and correlation failure were far more prevalent than the model allowed. The key lesson of Chapter 7 is that no model is smarter than the market's capacity for irrationality. Humility is the greatest component of any successful risk management system. Chapter 8, The Aftermath. This chapter examines the industry's response to the LTCM crisis and the subsequent evolution of risk management. The risk revolution. The LTCM crash forced the industry to fundamentally rethink risk. Focus on liquidity. Managers began to prioritize liquidity, the ability to exit a position quickly, above all else. The failure of LTCM was accelerated by its inability to sell into liquid assets during the crisis. Scenario stress testing. Funds began to move away from simple VAR models and towards scenario stress testing. They explicitly model for tail risk events, no effect, such as a global pandemic or a political default, that the Gaussian model ignored. The evolution of the elite. The crash solidified the elite class. Only those firms that have prioritized robust risk management and liquidity survived the subsequent crises. The fees 2 and 20 remain high because the industry had proven its capacity for absolute return and systemic resilience. Modern investing application. The aftermath of LTCM provides a crucial lesson in personal portfolio liquidity. Liquidity is the ultimate hedge. For the FIRE investor, the lesson is clear. Liquidity is your margin of safety. An adequate cash reserve, emergency fund, and investments in highly liquid ETFs ensure that you are never a forced seller during a crisis. Liquidity gives you the power to buy when the market is desperate. Stress test your portfolio. The average investor should apply scenario stress testing to their personal finances. Ask, what happens if my entire stock portfolio drops 40% and I lose my job simultaneously? If the answer is bankruptcy, the portfolio is not resilient. The key lesson of Chapter 8 is that crisis is the ultimate stress test. Resilience is not an option. It is a non-negotiable cost of admission to the investment world. Chapter 9, The New Breed. This chapter focuses on the post-2000 generation of hedge fund managers, many of whom came out of the quant revolution, and focus on adapting strategies to a more regulated, information-dense environment. Systematic discretion. The new breed often mix the quantitative rigor of Simons with the discretionary global macro views of Soros. Systematic strategies. Many managers use data and models to find opportunities. Systematic. Discretionary overlay. They use human judgment, discretionary, to veto or size the trades, especially to manage geopolitical and regulatory risk. The focus on alpha. The intense competition meant managers had to constantly innovate to generate alpha, returns above the benchmark. This required drilling down into highly specialized, niche areas. Modern investing application. The new breed confirms the futility of non-professional active management. The difficulty of alpha. The fact that the world's most sophisticated managers, armed with PhDs, supercomputers, and unlimited data, struggle to consistently generate alpha proves that the market is highly efficient. For the average investor to believe they can consistently beat the market using a few hours of research is the illusion of control. The passive solution. The new breed struggle validates the passive approach. The rational choice is to accept that alpha is almost impossible for an amateur and to instead capture the market's base return beta at the lowest possible cost. The key lesson of Chapter 9 is that the investment game is too hard for the amateur to win. Accept the base rate and focus your energy on generating income and disciplined saving. Modern context expansion. If Sebastian Mallaby were to update more money than God for today, he would see the core psychological, structural, and mathematical truths of the hedge fund model perfectly reflected in the current market extremes. The hedge fund lens on modern mania. Meme stocks as global macro at the retail level. Mallaby would see the meme stock phenomenon as a grotesque, democratized version of global macro. The strategy is highly concentrated, highly leveraged via options, and relies entirely on a reflexive feedback loop of sentiment, the social media narrative, and price. The risk is the same. The high volatility leads to an instant amplified loss when the trend breaks. Crypto and the arbitrage/speculation divide. Hedge funds treat crypto as both an arbitrage opportunity, exploiting mispricing across exchanges, a Jones-like strategy, and a directional macro bet, a Soros-like bet on the collapse of fiat currency. For the average investor, however, the lack of fundamental anchoring makes it pure speculation, a high-risk bet on the Joseph effect of hype. The rise of retail quant. The explosion of retail trading bots and algorithmic signals is the direct influence of James Simons. However, the success of Renaissance comes from proprietary data and speed that retail models cannot match. Mallaby would warn that the retail quant models are often flawed, non-scientific, and prone to systemic failure skepticism and due diligence. Staley the hedge fund's relentless focus on fundamental analysis, whether long or short, is the ultimate shield against FOMO and concept stocks. If the smartest analysts in the world struggle to find alpha, the average investor should be highly skeptical of any easy gain. Liquidity and the stress test. LTCM, the lessons from the 1998 crisis, emphasize that liquidity is paramount. Maintaining cash reserves ensures survival during a systemic shock, the unemotional model. Simons' success of the quants proves that unemotional execution is the only reliable path. For the average investor, this translates to using simple, automated ETF portfolios and never selling into a panic. The hedge fund elite secret is not a secret stock tip. It's a commitment to systematic intellectual and psychological rigor that the retail market is largely unwilling or unable to adopt. Closing reflection. We have explored the secretive, high-stakes world of Sebastian Mallaby's More Money Than God and discovered that the principles driving billions are surprisingly simple: discipline, flexibility, and a ruthless commitment to risk management. The hedge fund success is a triumph of scientific method and psychological rigor over human emotion. Here are 10 timeless lessons from the greatest hedge fund managers for the intelligent investor. Prioritize absolute return. Your goal should be preserve and grow capital, not merely to beat a benchmark. Capital preservation is the first priority. Neutralize market risk. Follow the original Jones concept and use non-correlated assets, bonds, cash, gold to hedge against systemic risk. Cut losses ruthlessly. Adopt the Soros philosophy. Ego is the enemy of profit. If a position moves against your fundamental thesis, exit immediately. Embrace the unemotional model. The consistent success of the quant firms proves that simple, unemotional formulas, like index funds, beat human intuition. Liquidity is survival. Make liquidity paramount. Cash reserves are the ultimate hedge against a no effect, and ensure you are never a forced seller. Avoid complexity. If you don't understand the underlying asset and its potential for correlation failure, avoid it. Complexity obscures risk. Leverage is for experts. The disciplined use of leverage requires systematic risk management that the average investor cannot replicate. Avoid retail leverage. Stress test your portfolio. Explicitly model for tail risk events, a 40% plus market drop, and ensure your personal finances can survive the worst-case scenario. Contrarian fortitude. Adopt a distressed investor's psychological stance. Have the conviction to buy what everyone else is selling, the ultimate low-price strategy. The game is too hard. Acknowledge that the professional game is too hard for the amateur to win. Accept the market's base rate beta at the lowest possible cost. How to apply these lessons right now. Automate your defense. Use automated investments into a globally diversified, low-cost ETF portfolio. This is the ultimate bias-free System 2 execution model. Build the NOAA reserve. Establish a cash or highly liquid bond allocation, e.g., 20% of your portfolio, specifically designed to withstand a major crash. This provides the firepower to buy at the trough. Review for liquidity. Ensure that your retirement assets are in highly liquid funds. Avoid any illiquid investments that would force you to sell at a fire sale price during a crisis. The hedge fund elite's greatest edge isn't access. It's psychological resilience. By adopting their rigor, you build a portfolio designed not just to grow, but to survive. And there you have it, the rigorous, challenging wisdom of Sebastian Mallaby's More Money Than God. It's a powerful validation that the principles of science and discipline are the ultimate generators of wealth. We hope this deep dive summary has given you the courage to look beyond the hype and manage your personal portfolio with the absolute rigor of a hedge fund chief. If you found value in this breakdown of More Money Than God, make sure to subscribe, Capitura, and click that notification bell. We're on a mission to bring you the world's most powerful financial wisdom, chapter by chapter. And you won't want to miss what's next, because we're covering another classic that can completely change how you think about money and markets. Thank you for investing your time with us. Now go and be your own best hedge fund manager.